$111 million worth of longs and shorts got liquidated yesterday. That kind of number always gets asked about the same way. What is actually going on here? In my view, it's the same thing it usually is. Big players positioning around obvious liquidity levels, pushing price into the zones where the most leveraged bets sit, and letting the market do the rest. That's not a conspiracy, that's just how a thin, leveraged market behaves. Because of that, there's a real possibility of more downside before this resolves. There's a visible pocket of liquidity sitting down near the $50,000 range, and even into the high 40,000s. That's exactly the kind of level that tends to get run before a market finds its footing. Not because anyone is guaranteeing it, but because it's the level with the least resistance if sellers keep pressing. Worth remembering, 2018's bear market took Bitcoin down roughly 84% peak to trough. 2022 took it down roughly 77%. Those were genuinely brutal drawdowns. What's happening right now doesn't remotely compare to either of those in depth, which is one reason to be cautious about calling any kind of definitive bottom, just because sentiment feels bad on social media. There's also no forced selling event visible right now, the kind that defined 2022 when over-leveraged lending platforms collapsed and FTX went down with them, dragging price from $69,000 all the way down to $15,500. That was a legitimate buying opportunity. And plenty of people, including longtime holders in this space, bought around the $16,000 level during that stretch. But the more important story this week isn't the liquidation number, it's a much bigger shift, one that's been building for months and became impossible to ignore in the last several days. The senator who made Bitcoin mainstream in Washington. For years, if there was one name in the United States Senate that Bitcoin holders trusted, it was CYNTHIA LUMMIS. The Wyoming Republican has personally disclosed holding Bitcoin since before she was even elected. She co-sponsored the LUMMIS-Gillibrand Responsible Financial Innovation Act, one of the first serious attempts at giving the digital asset industry actual legal clarity rather than years of regulatory ambiguity. She's spoken at Bitcoin conferences. She built her entire brand, in large part around being the senator who understood this technology when almost nobody else in that building did. That reputation wasn't manufactured. It was earned over years in a Congress where most members still can't explain the difference between a blockchain and a database. Lummis was, by any reasonable measure, Bitcoin's biggest institutional ally in Washington. It's worth remembering just how unusual that reputation was when she first built it. The LUMMIS-Gillibrand Responsible Financial Innovation Act, introduced years before the Clarity Act existed, was one of the first serious bipartisan attempts to give the digital asset industry clear rules rather than years of regulation by enforcement, where agencies sued first and explained the rules afterward. At the time, Lummis was one of a small handful of senators willing to publicly defend Bitcoin specifically, not just blockchain technology, in the vague, sanitized way most of Washington preferred to talk about it. She spoke about self-custody, about the importance of individuals being able to hold their own keys, and about Bitcoin's fixed supply as a genuine hedge against currency debasement. The exact philosophy this entire video, and the Bitcoin holder mindset itself, is built around. Which is exactly why what's happening right now deserves real attention. Not because it proves anything sinister, but because it's a genuine shift worth understanding clearly, rather than either ignoring or overreacting to. The turn. Now she's standing with Wall Street's biggest names. Lummis now chairs the Senate Banking Subcommittee on Digital Assets, and she's the lead negotiator pushing hardest for a full Senate floor vote on the Digital Asset Market Clarity Act before the August 2026 recess. On its own, that's simply her doing the job she's spent years building toward, getting comprehensive digital asset legislation across the finish line. Here's the part that's genuinely new and worth sitting with. Over the past several days, that exact bill has picked up public endorsements from BlackRock, Fidelity, Goldman Sachs, Charles Schwab, and Franklin Templeton. Combined, these firms represent more than $30 trillion in assets under management. BlackRock's Samara Cohen called it a necessary step for market structure. Fidelity, which manages somewhere around $7.1 trillion, is directly urging senators to bring it to a vote. Goldman Sachs CEO David Solomon said publicly that while it isn't perfect, it creates a level playing field. So the senator who built her reputation as Bitcoin's champion against exactly this kind of institutional gatekeeping is now the person carrying the ball for a bill that Wall Street's largest asset managers are actively championing alongside her. That's not an accusation. It's simply what's happening on the public record, reported directly by CoinDesk and multiple crypto trade outlets in the last week of July alone. Before we continue, I want to quickly mention something new for Bitcoin holders. I've just released the Bitcoin Holder Mindset, a new book designed specifically for people who want to become more disciplined, rational, and resilient Bitcoin holders, especially when volatility, fear, and market noise start testing their conviction. It's a highly recommended read for anyone who plans to hold Bitcoin for the long term because it focuses on something charts and price predictions can't solve: how you actually behave when the market moves against you. The book normally sells for $97, but as part of this launch, you'll be able to get it for just $47 with a special discount. And if you're interested, keep watching until the end of this video because I'll reveal the exclusive discount code you can use to unlock that $47 launch price. The link is right below this video if you want to take a look. It's worth understanding what this bill actually does before deciding what the institutional alignment around it means. The Clarity Act arrives roughly 1 year after the Genius Act, signed into law on July 18th of 2025, which created the first federal framework specifically for payment stablecoins. LUMMIS has described the Genius Act as the foundation, and the Clarity Act as the structure meant to be built on top of it, establishing which federal regulator, the SEC or the CFTC, actually has jurisdiction over which category of digital asset. That jurisdictional turf war between the two agencies has been one of the longest-running sources of uncertainty in this entire industry, arguably going back well over a decade. And resolving it is genuinely one of the things this space has been asking Congress for the longest. The current draft also includes more than a dozen provisions aimed at anti-money laundering and countering the financing of terrorism requirements, along with carve-outs addressing how the rules would apply to decentralized finance developers and validators, rather than treating every piece of crypto infrastructure as if it were a centralized exchange. Negotiations over the past several weeks have specifically centered on an ethics provision, whether state attorneys general should be able to bring criminal or civil cases tied to that provision, with LUMMIS describing that particular sticking point as a firm red line for Republican negotiators. None of that is settled yet, which is part of why the bill's final shape and its ultimate effect on smaller participants versus large institutions genuinely isn't fully knowable yet. Is this a betrayal, or just what winning looks like? There's a legitimate, published critique circulating in Bitcoin circles right now, and it's worth engaging with directly instead of dismissing it or exaggerating it. The core argument goes like this: a comprehensive federal compliance framework, registration requirements, continuous disclosure, legal teams, audit trails, costs real money to maintain. Large asset managers with $30+ trillion in combined assets can absorb that cost without blinking. A small, decentralized project or an individual running a node from their own home cannot. Under that reading, a bill marketed as bringing clarity to the market could also, as a side effect, raise the cost of participating in that market high enough that it quietly favors exactly the institutions that are now publicly endorsing it. And if that's true, then Bitcoin's biggest ally in the Senate is now the person delivering that outcome, whether or not that was ever the intention. That's a real substantive argument, and it deserves to be taken seriously rather than turned into a slogan. It's also not the only way to read this. The other side of it, which Fidelity and BlackRock have both said publicly, is that clear jurisdictional rules between the SEC and the CFTC could reduce the years of regulatory ambiguity that have made it harder for anyone, individuals included, to get straight answers about what's legal and what isn't. From that angle, LUMMIS teaming up with these institutions isn't a betrayal of the individual holder at all. It's the exact same fight she's always been in, just now with enough institutional weight behind it to actually cross the finish line after years of the bill going nowhere. What's not being asserted here, because it hasn't been demonstrated, is that LUMMIS personally stopped caring about ordinary holders, or that this is some kind of payoff. She's been public and consistent for years about wanting comprehensive crypto legislation passed before the window closes. She's said directly that failing to act risks pushing meaningful regulation off until at least 2030. Since a new Congress would have to restart the entire process. Whether teaming up with $30 trillion in institutional backing was the price of finally getting this bill moving, or whether it represents a genuine shift in whose interests the legislation actually serves, is a real open question. It is not settled, and anyone claiming certainty in either direction right now is overselling their own read of a bill that hasn't finished being negotiated. It's also worth noting who isn't fully aligned in this fight, because it complicates the simple story considerably. Reporting has also indicated that JP Morgan has backed changes to the bill that the broader crypto industry, including exchanges like Coinbase, have publicly opposed. That means this isn't a clean story of LUMMIS simply switching sides to join one unified Wall Street bloc. It's multiple institutions with different books of business, different regulatory exposure, and different incentives, all pushing on different parts of the same piece of legislation at once, with LUMMIS trying to hold the whole coalition together long enough to get a vote. Figuring out whether a shift like this is a genuine warning sign or simply what a hard-fought legislative win looks like is exactly the kind of judgment call the Bitcoin holder mindset is built to help with. It's not a trading system, and it doesn't try to predict where price goes next week. It's built around the discipline of recognizing which political and institutional news actually changes the thesis, and which is just noise dressed up as urgency. It's normally $97. Remember, staying to the end of this video unlocks the $50 voucher with code HOLDER26, bringing it to $47, and that part is still coming. Why self-custody matters, regardless of which side LUMMIS is actually on. Here's the part that doesn't change no matter how that question ultimately gets answered. And no matter which way the Clarity Act ultimately gets resolved, Bitcoin was built to let one person move value to another person anywhere on the planet without requiring a bank, a broker, a senator, or a government's permission to do it. That single design choice is the entire reason this asset exists, and it's the reason self-custody, actually holding your own keys rather than leaving coins on an exchange or inside an ETF wrapper, remains the difference between owning Bitcoin and owning a claim on Bitcoin that someone else controls. An ETF is a genuinely useful bridge for getting exposure inside a retirement account. It is not the same thing as holding your own keys. If a custodian freezes withdrawals, if a platform gets frozen by a regulator, or if a company managing billions in assets simply decides to change its terms of service, an ETF holder is exposed to every one of those decisions. A self-custody holder is not. That distinction was true before LUMMIS ever teamed up with BlackRock. It's true while the Clarity Act is being negotiated. And it will still be true regardless of the final vote count, regardless of whether this turns out to be a compromise or a capture. This is also why the day-to-day price chart, the liquidation numbers, the FOMC meeting, and the endless stream of headlines about who's aligned with whom in Washington can all be true and important, while still not being the thing that actually determines whether someone's Bitcoin holdings survive the next decade intact. What determines that is far simpler and far less discussed. Does the person actually control their own keys? Do they have a real plan for what happens to those keys if something happens to them? And can they sit through a 70+% drawdown like 2018 or 2022 without selling at the exact wrong moment because a headline about a senator and a bank scared them? The third point is where most people, including plenty of experienced holders, actually fail. Not because they don't understand Bitcoin's technology, because they never built a framework for how to think during the exact kind of week this has been. Big liquidations, a Bitcoin ally teaming up with Wall Street, and no shortage of people online insisting they know exactly what it means. The asset didn't change this week. The alliances around it did. Concretely, self-custody done properly involves a handful of decisions most people put off far longer than they should, and none of them require deep technical expertise to get right. It means moving coins off an exchange and onto hardware that generates and stores private keys offline, disconnected from any internet-facing device. It means writing down a recovery phrase correctly, storing it somewhere fire-resistant and water-resistant, and critically, storing a second copy somewhere physically separate from the first so a single house fire or flood doesn't wipe out both at once. For anyone holding a meaningful amount, it increasingly means considering a multi-signature setup where more than one key is required to move funds. So no single point of failure. A lost device, a coerced password, a single mistake can result in a total loss. It's worth being specific about why a multi-signature setup matters more than it might initially sound like it does. A standard single key wallet has exactly one point of failure. Whoever has that one key, or whoever can coerce the person holding it, controls the funds outright. A properly configured multi-signature arrangement, by contrast, might require 2 out of 3 separate keys, held in 2 separate physical locations, sometimes by 2 separate people, before any transaction can be signed. That structure means losing one key doesn't mean losing access, and it means a single bad actor, a single stolen device, or a single moment of duress isn't enough on its own to move funds. It's more setup work up front, and it's exactly the kind of thing that feels unnecessary right up until the moment it isn't. A moment that has nothing to do with which senator is aligned with which bank in any given news cycle. It also means solving the problem almost nobody wants to think about. What happens to those keys if something happens to the person holding them? A private key that only one person knows how to access effectively disappears with that person, and there are already well-documented cases of meaningful amounts of Bitcoin becoming permanently unreachable for exactly that reason. A real plan means someone else, a spouse, an estate attorney, a trusted family member, has a clear, secure, and legally sound way to access those funds without that plan itself becoming a security risk in the meantime. Most Bitcoin holders know what they should do when the market is calm. The real test comes when Bitcoin suddenly drops, the headlines turn negative, and every voice online starts telling you that this time is different. That's when good intentions can disappear. Without a plan made in advance, a long-term holder can start making 10-year decisions based on 10-day price action, mistake media panic for a change in fundamentals, or sell simply because the emotional pressure becomes too difficult to tolerate. That is exactly what the Bitcoin holder mindset was built to solve. It gives you practical frameworks for building a pre-committed plan, sizing your position around what you can actually tolerate, recognizing the recurring psychology of Bitcoin cycles, separating signal from noise, and developing the identity of a holder who doesn't have to make the same emotional decision every time volatility hits. The book normally sells for $97, but if you stay with me until the end of this video, I'll reveal how you can get it for just $47. I won't reveal the discount code yet. Stay until the very end, because that's where I'll give you the exact code to use at checkout and unlock the $47 price. The FOMC meeting and what actually deserves attention. Right now, briefly, on the macro side, because it does connect to all of this, markets are currently pricing in roughly an 82% chance of a Fed rate cut by September. That number matters more for short-term traders positioning around the decision than it does for anyone holding with a multi-year horizon, but it's still worth tracking because rate decisions do influence how much liquidity is sloshing around markets broadly, Bitcoin included. What's more useful than trying to predict the Fed's next move is looking at what's already happened to the dollar's purchasing power over a longer stretch. Going back to commentary from July 23rd of 2020, plenty of economists at the time argued that trillions of dollars in stimulus wouldn't meaningfully show up as inflation. In the years since, the dollar has lost roughly 30% of its purchasing power. And that's not a prediction. That's already happened. And it's a big part of why an asset with a fixed, transparent supply schedule continues to matter, regardless of which senator is standing next to which bank in any given month. None of this is offered as certainty about what happens next in price. Anyone who tells you they know exactly where Bitcoin goes from here in either direction is selling confidence they don't actually have. What can be said with real confidence is narrower and more useful. The case for holding an asset with a fixed supply in a world where currency purchasing power keeps eroding doesn't depend on any single alliance in Washington this summer. What history actually teaches holders who made it through. Looking back at both 2018 and 2022, the pattern among people who came out the other side with their position intact wasn't that they correctly predicted the exact bottom, or that they had perfect information about every political development along the way. What the people who made it through actually had in common was simpler. They had already decided, before the drawdown started, roughly how much they were holding, why they were holding it, and what would actually have to change about the underlying thesis for them to sell. A senator's new alliance was never going to be on that list. The people who got hurt worst in both cycles tended to share a different pattern. They'd bought with money they needed on a shorter timeline than they admitted to themselves. They were holding on an exchange rather than in self-custody. And they were making decisions in real time, based on whatever headline happened to cross their feed that day. A senator teaming up with Wall Street looks urgent in the moment. It almost never actually changes the answer to the one question that matters. Does this change what Bitcoin fundamentally does at the protocol level? For the overwhelming majority of headlines on any given week, including this one, the honest answer is no. What this actual shift means for anyone holding right now. Pulling this together, the senator who built her entire reputation as Bitcoin's biggest ally in Congress is now the lead champion of a bill publicly backed by firms managing north of $30 trillion. That's either the moment a years-long fight finally gets the institutional weight it needed to actually pass, or it's the moment individual holders quietly become an afterthought in their own legislation. Right now, honestly, nobody outside the negotiating room knows for certain which one it is, and the ethics provision still being fought over this week could meaningfully shift the answer either way. What can be said clearly is this: the alliance itself, whatever it ultimately produces, doesn't change what a self-custodied Bitcoin holder actually controls. It changes the regulatory environment around exchanges, custodians, and on-ramps operating inside U.S. borders. It does not touch the protocol, the fixed supply schedule, or the ability to move value without permission. Anyone holding through this needs a framework for telling the difference between news that changes that underlying reality and news that's simply a very loud headline about who's standing next to whom in Washington this week. There's also a simpler, less dramatic possibility worth taking seriously that this is exactly what a difficult multi-year legislative fight looks like in its final stretch, when a bill finally has enough momentum to actually pass, and the coalition holding it together necessarily includes players who wouldn't have touched it 2 years earlier. Politics at this scale rarely moves without compromise, and a compromise that finally delivers legal clarity after a decade of regulatory limbo isn't automatically the same thing as a sellout. The honest answer this week is that both readings remain genuinely possible, and the ethics provision still being negotiated could tilt the outcome meaningfully in either direction before any final vote happens. 3 things worth doing this week, regardless of how this plays out. First, regardless of which way the Clarity Act ultimately lands, or what LUMMIS's alliance with Wall Street ultimately produces, checking exactly where any Bitcoin currently sits is worth doing this week specifically. Sitting on a centralized exchange is not the same thing as self-custody, no matter how large or reputable that exchange is. If a meaningful amount is sitting on an exchange right now, this is a reasonable week to begin the process of moving it into a hardware wallet, starting with a small test transaction before moving the full balance. Second, for anyone who already holds in self-custody, this is a good week to actually test the recovery process, rather than assuming it works. That means confirming the recovery phrase is written down correctly, stored in 2 separate physical locations, and that it can genuinely restore access on a fresh device using only that phrase, with no other information or memory required. Third, it's worth deciding in this calm moment rather than during the next drawdown what would actually change the underlying thesis enough to justify selling. And being honest that a senator's new political alliance on its own almost certainly isn't it. Writing that answer down now, while this is still just a headline rather than a personal crisis, is what separates a plan from a reaction. Most people watching something like this are dealing with the exact same 3 things at once. Uncertainty about what a shift like LUMMIS teaming up with Wall Street actually means, uncertainty about whether a price drawdown is close to done or has further to go, and underneath both of those, an approach to self-custody that was never really built with intention. Coins sitting wherever they happen to end up, with no real plan and no real framework for weathering weeks like this one. That gap doesn't resolve itself, and it's not a one-time cost. Every week spent without a clear framework is another week of reacting to headlines instead of holding with intention. Another chance to sell at exactly the wrong moment because a senator's alliance or a liquidation number on a chart triggered a decision that had nothing to do with Bitcoin's actual fundamentals. That's exactly why the Bitcoin holder mindset was built the way it was. It's not a trading signal service, and it doesn't guess at next week's price or next month's Senate vote. It walks through real self-custody setup, a survivorship plan for your keys, and a simple framework for separating signal from noise. The same framework that would make a week like this one far easier to sit through calmly. Most people watching this are dealing with the same underlying problem, even if it looks different on the surface. You see a headline like LUMMIS teaming up with Wall Street, Bitcoin drops sharply, the media starts talking about what it means for the market. And suddenly, you're forced to make a decision while you're emotional, uncertain, and surrounded by conflicting information. The problem is that Bitcoin doesn't give you the luxury of making those decisions in a calm environment. If you don't already have a framework for separating signal from noise, matching your decisions to your actual time horizon, sizing your position so you can genuinely tolerate the drawdown and knowing what you will do before fear or FOMO takes over, every major move becomes another psychological test. And that's where the real cost begins. It's not just the possibility of selling during a panic or buying during euphoria. It's spending years saying you're a long-term holder while your behavior is still being dictated by headlines, short-term price movements, and whatever the market is making you feel that day. That's exactly why the Bitcoin holder mindset was built. It doesn't give you a price prediction or another trading signal to follow. It gives you the psychological operating system for holding Bitcoin, pre-commitment rules for when volatility hits, the sleep test for position sizing, the zoom out rule for keeping short-term price action in perspective, the cycle emotion map for recognizing recurring market psychology, the signal versus noise framework for controlling your information diet, and the identity-based system for becoming the kind of holder who doesn't have to reinvent their discipline every time Bitcoin moves. And now that you've made it all the way to the end, here's the offer I promised you. The Bitcoin holder mindset normally sells for $97, but your $50 voucher is now unlocked, bringing your price down to just $47. And you're not being asked to make a blind decision. The purchase is backed by a money-back guarantee, so you can go through the material, use the frameworks, and decide whether it delivers real value for you. Your exclusive $50 voucher code is HOLDER50. Go to the link below this video, add the Bitcoin holder mindset to your purchase, and enter HOLDER50 at checkout. The voucher takes the price from $97 down to just $47. If you've ever watched Bitcoin fall and wondered, am I supposed to hold? Or is this actually different this time? This book was designed to help you answer that question with a process instead of an emotion. You made it to the end. Now claim your $50 voucher, use HOLDER50 at checkout, and get the Bitcoin holder mindset for just $47 while the offer is available. Regardless of whether CYNTHIA LUMMIS' alliance with Wall Street's biggest names turns out to be the deal that finally protects individual holders, or the moment they got quietly outnumbered at the negotiating table, Bitcoin keeps doing the one thing it was actually built to do, moving value from one person to another anywhere on Earth without needing anyone's permission. That fact hasn't changed this week, and it isn't going to change because of who's standing next to whom in Washington. None of this, not the liquidation figure, not the Clarity Act, not this new institutional alliance, not the FOMC odds, is offered as a signal to buy, sell, or hold anything specific right this moment. All of it is offered as exactly what it is, the current state of a fast-moving legislative process, a fast-moving market, and a currency that has been losing value for years regardless of which senator is aligned with which bank in any given month. What each person does with that information and how calmly they do it is the entire difference between a holder and someone who happens to own Bitcoin until the next scary headline. This is general commentary and education about markets and pending legislation, not financial, legal, or tax advice. And it is not a recommendation to buy, sell, or hold any specific asset, and it is not an accusation of wrongdoing against any named individual. Bill status, institutional endorsements, and market conditions can all change quickly, sometimes within the same week this was published. Anyone acting on anything discussed here should confirm the current status of any legislation directly at congress.gov, should verify current institutional endorsements directly through primary reporting rather than secondhand summaries, and should speak with a qualified licensed financial advisor before making any investment decisions.